You've been told your whole life, probably since the first dollar you ever made, that the smartest thing you can do with your money is to diversify. It's basically financial gospel, right? Spread your risk, don't put all your eggs in one basket. You hear it from everyone. But today, we're going to take that whole idea and just dismantle it. We're going to explore the argument that this one piece of advice, the advice that's supposed to keep you safe, might be the very thing that's stopping you from ever building real, life-changing wealth.
You know, the entire modern financial world is built on one very seductive promise: safety. They sell you products designed to smooth out the bumps, to minimize the scary ups and downs. But what if that obsession with safety is actually a trap? What if trying to avoid all the short-term risk is just a guarantee for long-term mediocrity? The whole idea we're digging into today is that the safe path, the one with tons of diversification, isn't just kind of bad. It's actually the riskiest path you can take if your goal is to win big. Why? Because it guarantees you will never, ever fully capitalize on your absolute best ideas. Okay, let's get into it.
I want you to really put yourself here. You're at the racetrack. You can feel the energy. You've got $1,000 in your hand. But you're not just a gambler throwing a dart. No, not today. Today, you're an expert. You've done the work. You've spent weeks, maybe months, studying. You know the jockey, the trainer, the horse's stats on this exact kind of track in this weather. You've done a deep, deep dive, and all your research points to one single, undeniable conclusion. Horse number 4 is a champion. It's not a hunch. It's a certainty you've earned through hard work.
So you start walking to the betting window, feeling confident. But then, that little voice in the back of your head starts whispering. It's the voice of caution, the voice of every piece of safe advice you've ever heard. But what if? What if there's a freak accident? What if you're wrong? You could lose everything. And that fear, that ghost of total failure, it starts to just overwhelm your conviction. So, you back down. Instead of acting on your expert knowledge, you hedge against it. You make the quote-unquote smart move. You spread your $1,000 out, putting $100 on every single one of the 10 horses, and you walk away feeling relieved. Phew, you tell yourself, I've minimized my risk. There's no way I can lose.
And you were right. You didn't lose your $1,000. When the race is over, you go and collect your small winnings from the one horse that won. But after you subtract the 9 other bets you lost, the 9 bets you knew were worse, you're left with exactly what you started with, $1,000. You successfully protected yourself from any loss, but you completely gave up any chance of a real win. That isn't a victory. It's nothing. It's a tie. And that is the precise, soul-crushing result that over-diversification delivers. It's a strategy that's perfectly designed for mediocrity. It's a strategy for not losing, which is a completely different game than a strategy for winning.
Now look, this idea isn't some crazy new theory. This is the bedrock principle that the greatest fortunes in history were built on. Andrew Carnegie, who came to this country with nothing, didn't build a global steel empire by putting a little money in railroads, a little in textiles, a little in shipping. No, he put every dollar and every brain cell he had into steel. And the second half of that quote is the key. It's everything. And then watch that basket. This isn't about being a reckless gambler. It's about intense, obsessive focus. It means you know that one investment so well that you see problems before they happen and opportunities before anyone else. It's all about conviction plus vigilance.
All right, so let's move away from analogies and get into the actual analysis. Let's break down the flawed logic that sells diversification as the ultimate answer for people trying to build wealth. Because to really get behind the alternative, we first have to understand why the old way mathematically guarantees an average result. And for most of us, an average result just isn't going to cut it.
You know, Peter Lynch, the legendary guy who ran the Fidelity Magellan Fund and got like 30% returns a year for over a decade, he had a great term for this. He called it di-worsification. He saw it all the time. Investors would get so scared they just keep buying more and more companies until their portfolio was just this big, messy, unfocused pile of stuff. And every time they added some mediocre company just for the sake of diversifying, they weren't making themselves safer. They were just pouring water into a great glass of wine. They were diluting the power of their absolute best, highest conviction ideas.
This right here, this is the question that cuts right to the heart of it all. Just think about it logically for a second. Let's say you do 100 hours of hard research, and you find a truly amazing company. It's got everything: a great product, a brilliant CEO, fantastic financials. This is your horse number 4. It's your single best idea. Now, the old rules of diversification say you should now take a big chunk of your money away from that brilliant idea and put it into your 5th best idea, and your 10th best idea, and even your 20th best idea. I mean, honestly, how good can your 20th best idea really be? By definition, it's something you have way less conviction in, that you've researched less, that has more problems. You are actively starving your winners just to feed your losers. It makes no sense.
And look who's saying this. This is Charlie Munger, Warren Buffett's partner at Berkshire Hathaway, one of the sharpest minds in investing ever. And he doesn't throw words around lightly. So when he uses a word like insanity, he means it literally. The whole argument for over-diversifying is that since great investments are rare, you're forced to buy worse ones just to fill up a portfolio. Munger is saying that's completely backwards. The fact that great opportunities are rare is the exact reason you should bet huge when you finally find one, not water it down with a bunch of mediocre garbage.
Okay, so if diversification is the road to nowhere, what's the alternative? Well, it's not about being reckless, it's about adopting a totally different mindset, a different way of making decisions. And to really hammer this new discipline home, Warren Buffett came up with this simple but incredibly powerful mental model. He calls it the 20-slot punch card.
I want you to just imagine this. The day you make your very first investment, someone hands you a little card. You know, like one of those cards you get for a free coffee? Except this one is infinitely more important. This card has only 20 little slots on it. Just 20. That's all you get.
The rules couldn't be simpler. Every single time you invest in a new company, you have to take out a hole punch and punch out one of those 20 slots. And once that 20th hole is punched, that's it. Your card is full. You can never, ever make another investment again for the rest of your life. No do-overs, no second chances, no buying a new card. 20 is your lifetime limit. The sheer weight and finality of that idea is what makes it so powerful. Now, if you had that punch card in your wallet, how would you act? Seriously, think about the investments you've made. Would you have used one of your precious, irreplaceable 20 slots on that speculative meme stock that everyone was yelling about for a few weeks? Would you really burn a lifetime opportunity on some hot new company that has no profits just because you were afraid of missing out? The answer is a clear, absolute no. Of course not. The cost is just way too high. A casual bet is no longer casual. It's a permanent mark on your life's work.
This way of thinking forces a complete change in your behavior. It makes every decision feel monumental, like a lifetime commitment, because it is. You'd start treating every potential investment with the seriousness it deserves. You wouldn't just read the last annual report, you'd read the last 10. You'd study the competition until you knew them inside and out. You would wait and wait and wait, patiently, for an opportunity that was so good, so obvious, that you felt it was almost a certainty. And only then, when your conviction was absolute, would you punch the card. And when you did, you wouldn't just buy a little bit, you'd bet big. That is the discipline that builds fortunes.
So the philosophy is clear, right? Be super selective, wait for the perfect pitch, and then swing for the fences. But that brings up the most important question of all. How in the world do you actually find one of those 20 opportunities? How do you develop the skill to know when you've struck gold? Well, it means you have to stop being a passive investor who just buys into stories and start becoming a forensic analyst who investigates businesses.
Look, real financial safety, the kind that lets you sleep peacefully at night, it doesn't come from owning 500 different stocks. It comes from owning a small handful of businesses that you understand down to the bone. Businesses that are like financial fortresses. I use a simple framework I call the holy trinity of financial analysis. It's just 3 critical filters. Any potential investment has to pass through all 3 of these gates before I would even think about using one of my 20 punch card slots on it.
So the first filter. This is the absolute foundation of everything. You've probably heard the saying, profit is an opinion, but cash is a fact. And it is so, so true. A company's net income, the number on the bottom of the income statement, it can be fudged and manipulated with all sorts of accounting tricks. I don't even look at it at first. What I care about is actual cash from operations. Is real, hard cash piling up in the company's bank account? Or is all their so-called profit just an accounting fantasy tied up in money they're owed but haven't actually collected? A business with big profits but no cash is a time bomb, and this filter lets you spot it a mile away.
All right, the second filter is what separates a pretty good business from a truly great wealth compounding machine. It's called operating leverage. And simply put, it just means the business has high fixed costs, but super low costs for each additional sale. The classic example is a toll bridge. It costs $1 billion to build it, right? Huge fixed cost. But once it's open, how much does it cost to let one more car drive across? Basically nothing. So once enough cars are paid to cover the fixed cost, every extra dollar of toll money is almost pure profit. If their revenue goes up 10%, their profits can explode by 30%, 50%, or even more. The modern version is a software company. It costs a ton to write the code, but almost nothing to sell one more subscription. These are the kinds of businesses we are hunting for.
Now this third filter, this one might be the most powerful, and it's the one most people miss. It's all about the working capital cycle. And this comparison makes it super clear. Think about a supermarket. When you buy groceries, you pay them instantly. That cash is in their bank account tonight. But the supermarket doesn't pay its suppliers, the farmer, the baker, for maybe 60 or even 90 days. So this creates this magical situation called negative working capital. The supermarket is basically getting a giant, constant, interest-free loan from all of its suppliers, and it can use that free money to grow its business. It is one of the most incredible, sustainable, competitive advantages a business can possibly have.
So finding one of those rare companies that passes all three of those tough tests, that's the science part of the equation. That's the analysis. But it's only half the battle. The other half, and honestly, it's probably the harder half, is the art. It's having the psychological strength, the emotional discipline to actually act on your research, especially when it means you're standing all alone, away from the crowd. This requires an outlier's mindset.
Just look at the behavior that Wall Street encourages. It's a culture of constant motion, of frantic activity. You're supposed to be chasing every little trend, day trading on news headlines, always terrified that you're missing out on the next big thing. And all that frantic energy leads you to diversify into a bunch of garbage you don't even understand, just so you feel like you're in the game. The outlier, the person with the 20-slot punch card, they do the exact opposite. They're defined by their inactivity. They're the ones sitting quietly in a room, just reading and thinking. They ignore 99% of the noise, just patiently waiting for that one single perfect opportunity to show up.
The legendary baseball player Ted Williams used to say his secret was just waiting for a fat pitch right in his sweet spot. He knew that if he swung at every pitch near the plate, he'd be just an average hitter. But if he had the discipline to only swing at the perfect pitches right down the middle, he could be one of the best of all time. Well, investing is the ultimate no-called strike game. The market will throw thousands of pitches at you every single day. Hey, look at this stock. Don't miss out on AI. Get into crypto now. And the most beautiful rule of this game is that you do not have to swing at any of them. There is zero penalty for standing there bat on your shoulder for weeks or months or even years, just waiting for that one perfect pitch to come right into your wheelhouse.
And that brings us to the final and most important thing. This is the challenge I want to leave you with. I really want you to do this tonight. Go look at your own portfolio, line by line. And for each company you own, ask yourself this one deeply uncomfortable question. If you got an alert tomorrow morning that the stock market was closing and would not reopen for 10 years, which of these companies would you be absolutely terrified to be stuck holding? Which ones would give you that sinking feeling in the pit of your stomach knowing you were locked in for a decade?
That feeling of terror, that's your gut screaming at you that you own a 10th or 20th best idea. It's the filler. It's the stuff you bought just to be diversified. Those are the ones to get rid of. But the companies that gave you a feeling of calm, or maybe even excitement at the thought of being a forced long-term partner, the businesses you believe in so much that a 10-year lockup actually sounds like a great opportunity, those are your champions. Those are your horse number 4s. Keep them, bet heavily on them, and watch that basket.